When you look at what's going to happen over the next 6 to 12 months, I'm actually a little bit more optimistic on the equity markets, because I think the first half of this year was all about questions. I think we're going to get the answers during the next 6 months or so. And what I mean by that is I think inflation, right? It's been a big concern. I think it's going to be on a steady downward trend by the end of this year into next year. I think the Fed's tightening cycle is going to end either by the end of this year, early next year. And then the midterms, they'll be over. And one little important point to note is that 12 months after the last 19 midterm elections in the post-World War II era, the market's been up every single time. So
there's a lot of buzz from government quarters with a resounding effect on the economy, hence all the equity markets. The important question here is, are these wise policies or witty politics? Every government wants to set a legacy. More often than not, politics is put on the front burner, while sound economics play second fiddle. The seasoned fund manager and CEO of ARK Investments, Cathie Wood, would in today's episode dissect the Fed's actions to help us discern if we're seeing good policies coming into play or just policies that are good enough for the polity. One thing that you can do right now is to subscribe to this channel. We always appreciate it.
The downturn during the first half of the year, 2 quarters of negative real GDP growth, that downturn might be worse than has been reported. So I'll get into that in a little bit. And it means that the inflationary pressures that are concerning the Fed are probably going to unwind now very quickly. It is true, the last year, against our expectations, has been a very difficult one when it comes to inflation. I never dreamed, given all the new technologies in place to take care of these things, that the supply chain issues that started in April of 2020 would extend for more than 2 years. It's still pretty shocking to me. We do believe those are loosening up now. We're getting all kinds of reports that that is the case. And we also did not predict, no one did, the Russian invasion of Ukraine, which has sent food and energy prices soaring, which is a really cruel tax on the consumers around the world. So I've also not been in a period where fiscal and monetary policy during a recession have actually tightened up. Typically, fiscal and monetary policy are contracyclical. In other words, when the chips are down, the economy is in recession, usually fiscal stimulus and monetary stimulus follow pretty quickly. And instead, what we're getting now is the opposite: fiscal policy tightening, including the Inflation Reduction Act, and monetary policy tightening, and tightening aggressively.
Everyone that knows a thing or two about economics and stock markets knows that politics plays a big factor in the market movements, and everyone that knows anything about politics knows that the economy is a big player in politics. So big that recent polls show that 85% of voters think this is one of the most important topics for them. Based on the yin-yang relationship of politics and economy, it is only wise to consider one when judging the other. In November, 469 seats in Congress would be contested. This would mean a lot of government policy should be expected from now till November, aimed at positioning the government in good standing with voters. We are already seeing a lot of movement in policies, and the market has been responding according, though not positively so far. The United States has recorded a 40-year record inflation of 9.1% in June this year. This means inflation would be the priority of the government. Cathie thinks Fed Chairman Jerome Powell is more focused on bringing inflation down than he is concerned about other sectors of the economy. The only strategy in place seems to be more quantitative tightening. Cathie thinks the markets need more simulations, more funding that would drive up productivity, loosen up the stiffness of investors, which is usually the expectations in economic situations, as we are seeing this year.
Only focus was on inflation. So that was a clear message. We don't care. We just want 2% inflation. Now, the reason this is so important from an investor's point of view is if you look at valuation, so PE ratios in the 70s and early 80s, I think they bottomed out somewhere between the 6 and 7 times range. So 6 or 7 times earnings. And I believe that was in 1982. And that was because inflation had been ingrained and the discount rates, I mean, we were at a double-digit interest rate, so valuations should have been that low. Now, many people believe, certainly the bears do, that we are back in a 70s environment. And that is why they're very negative on the equity market. Because today, the PE ratio of the S&P 500, assuming $200 for S&P earnings this year, and I actually think that's too aggressive, but that's close to the consensus estimate, the S&P 500 is selling closer to 20 times. So many people who are seeing another big drop in the market are focused on valuation and that metric. And yet the bond market does not agree with this at all. In the 70s, bond yields just kept going up inexorably. And that is not happening now. If you look at the 10-year Treasury bond yield, it is having trouble getting above and then staying above 3%. We dropped to 2.5%, for example, in August. And now with the Fed's latest rhetoric, and especially Chairman Powell's Jackson Hole presentation, the bond market has back up into the threes.
Cathie Wood is not the only one raising alarm on the possible pitfalls that lie on the path the Fed is taking on the U.S. economy. Economic historian Neil Ferguson that the economic collapse we are likely to witness in the coming months would be like that of the 1970s, but even worse. It should be recalled that the 1970s was plagued by wars in the Middle East that cut off oil supplies, just as we're seeing now with the Russia-Ukraine war. Unfortunately, it's even worse now because the United States is not in good relations with economic giants like China at this crucial time. Larry Summers, who formerly served as Treasury Secretary, is also calling out the Fed for not addressing employment head on its considerations. He says the Fed is only causing more confusion for stakeholders in the equities market. Many experts are pointing out the fact that the IRA's impact on the economy will at best be marginal. Looking at statistics from Moody's Analytics and Analysis from the Congressional Budget Office, we can only expect an inflation reduction of 0.33%, and this would only be after 2025. Cathie Wood also thinks the yield rate of bonds is actually too low for a time like this. Many experts say the yield should be over 4%, not the 3% it is at now. We wait to see if the Fed acts on these issues. For now, we have our fingers crossed and hope for the best. If you enjoyed this video, like, subscribe, and leave a comment below. We hope to see you again.